All right, I hope you guys enjoyed the first video, getting everything set up, going through a couple, tips, pointers on getting the first templates put on. In this video, we're going to talk about kind of the origin story. Where did Marty come from? Why did I create this strategy that honestly and truly on paper didn't really make a lot of sense? I did not think that this strategy should work. And it took a long time to really get through the development process of this strategy. So it's been vetted a ton. And there are pros, there are cons, and you want to understand the whole picture. If you're going to trade anything, the problem with, I believe, with buying a bot from anyone is you don't understand the underlying principles of a strategy. And the only way that you can get really, really good at something is if you understand why the process is occurring. And so this took a while to be built, but I put in kind of the underlying origin story of Marty here in the download Marty Martingale area. So you have the first little bit, and then I added this, what is Marty Martingale, right? So long story short, the idea came back probably in October when another member of YMI and I had started working on a way to pass prop firm challenges. That is really at the core what this was developed for. It came initially from an idea in a paper that I read where, if going back to like 1993, if you had bought at the close of the market and sold at the open, your returns were so much greater than if you had just bought at the open and sold at the close. There was something like 2,000 and some odd percent. You can search this out. That you would have made had you bought the close of day and sold at the open, essentially holding through the overnight session versus buying at the open and selling at the close. So I started creating this strategy and started incorporating some exponential moving averages and things like that into it, because I was like, man, if this strategy has been proven to work over decades and decades, let's just build another bot. Let's just build another strategy and see where it goes. And so that strategy eventually morphed into what Marty Martingale is, looking at different things, and Josh always wanting to, get these perfect win rates. I was like, you're going to take on more risk. You take on more risk to improve your win rate. And we started this whole, I watched a video on the Martingale betting system, a little YouTube short, and I was like, you know what? To hell with it. Let's try it. Let's just see if this works. And essentially the reason why, the underlying principle why Marty works is because of something in stochastic calculus. It's very counterintuitive. And kind of like what I was saying in here is that you're increasing your size of your trade after your losses. So you're optimizing entry times for higher win rates, but you are increasing your contract size on subsequent trades that you end up taking. And of course, these are filtered out using things like time, moving averages, the average true range, trend directions, volume, and there's also a custom event filter built into this that I've never seen in any other bot or anywhere else, so that you can filter out things like CPI, which is Consumer Price Index, NFP or Non-Farm Payroll, PPI, which is Producer Price Index, FOMC. We're talking the whole range of different economic news events. This bot has all of those built in, and so we update that as time goes on, and we add in all of those dates so that you can backtest with or without those days. Because the problem is the market is dynamic. The market is always changing. And so the big thing that you have to realize as you're running a strategy is you have to ebb and flow with the market. As the market is ebbing and flowing and changing, you have to also do that as well. And so one of the really cool things about this particular strategy is that it has an event filter that allows you to do that. And I'll show you a little bit more as we do some back testing. Going back to this, what is stochastic calculus? Well, stochastic calculus is a branch of mathematics. It's a model it's used for modeling randomness, essentially, and it uses that to effectively pick the right size trade. Like it talks about in here, we're analyzing the influence of random factors on market movements. One of the things I didn't like when I first started trading was this idea that the market's random. I wanted, as an A-type personality, I wanted to nail it down. And the reality is the market, as we can look at any chart, right? The market goes up and down and side to side. I mean, if we look at this chart here, there is random variance that occurs often throughout the market before the eventual trend moves. So what we have been able to do, and because of the versatility of the strategy, we can create different variances or different versions of the strategy, some that are looking for very tight ranges where maybe we only are looking for, maybe 3 to 7 points, right? Whereas maybe some of these other strategies, like our NQ strategy here, for example, if we swap over here and take a look at the chart and go to the chart section, maybe some of these trades end up being a little bit longer in trades. We can take a look at this trade right here. Definitely a great trend movement right here. And so Marty was able to wait, and get in on a great move right here, getting one win. It gets another breakout above this EMA, another win. And then we get this third beautiful move up here to the upside right as this trend starts to die out. And you're going, Cameron, that was totally just, you planned all that out. I swear to you, that was just the first trade that ended up popping up on here. But the robustness of the strategy is really great because it works great for some of these longer movements. But again, you're gonna think I totally planned this out here, even though I really didn't. But if we go to this chart right here for this version, and let's scroll and see if we can find maybe a first win. There we go. There's a first win right there. We could see one where it actually loses, right? So we take one loss right here, and then we end up taking on more size. We went from 1 contract to now 3 contracts, and we ended up getting our win right there. Or, on another separate day, we waited quite a bit again, and you're waiting for that rubber band effect essentially in the market. You're waiting for that market. We just went down, finally got in. And did we hold it maybe a little longer than we wanted? Sure. And we can adjust that in the settings. But we got this great rubber band effect where the market snapped back and we got a large movement. And we have some other strategies or versions in here as well that we haven't run this one yet. I'm going to run it in another video, but where we're only looking for maybe 7 points. So we have these different versions that can really help you have kind of a portfolio of strategies that help you to dynamically adjust for the ever-changing market conditions. But going back to where Marty started and where it came from the understanding that the market is random, and some facet and some pieces, it doesn't matter how great your technical indicators are, it doesn't matter how much research you do, there's some randomness involved in this. And so you have to have different tools for different jobs, but using that random or understanding of randomness in the market, that stochastic calculus allows us to play the game a little bit better. Marty uses things to filter out different events. We filter out economic news events. We filter out things like, different windows of time. You can have a longer period EMA or an SMA. You can have the bot has so many different options for the moving average. If we scroll down here, we have the whole moving average. You have linear regression. You have the SMA, SSA, which is a simple smooth moving average. You have the TEMA, TMA, VWMA. You have the WMA and the ZELMA. So many different filters, and we're going to get into that in a separate video. But this video is really just to help you kind of start to understand what's causing these trades to occur, and where is the origin story. I'm going to get into all of the different little settings on the strategy here in the next video. But it's an incredible kind of culmination of work that I've put in with different guys to create something that oftentimes you start something and you're like, it doesn't feel like it's going to work, and somehow it's really about putting your biases aside and realizing that sometimes the things that you think are not going to work in the market actually do. And we're going to jump into that topic a little bit more as we talk about backtesting and needing to test ideas that sometimes you don't think are going to work, but they actually absolutely freaking do. And I mean, if we look at the results here, right? I mean, how can you how can you argue with 17,000 on a few contracts? This version does not trade very many contracts, so 17,000 year to date, $5,000 drawdown, not too shabby. And if we go just over here to Phantom of the Opera, again, this one with less than $4,000 drawdown on $34,000 year to date, great numbers. You can't, again, argue with the data at the end of the day. And so we're going to dive into that a little bit more, and I will catch you in the next one. Talk to you soon.